This is the most important video I've made on this channel. Not because it covers the most complex topic, it doesn't, but because the people it's aimed at, the people who will recognize themselves in it most completely, are the people losing the most money without knowing it. Not through the 60% trap specifically, not through a single catastrophic decision, but through a quiet accumulation of smaller mistakes. Mistakes that each feel harmless in isolation, mistakes that, taken together, add up to tens of thousands of pounds overpaid to HMRC across a career. The most expensive tax mistakes are not the dramatic ones. They are the unremarkable ones, the ones that look fine, the ones nobody flags, the ones that have been happening for years. My name is Mark. Welcome back to Wealth Architecture. Let's go through them. We've talked about adjusted net income in earlier videos, but it needs repeating here because everything else depends on it. If you don't know your adjusted net income, the number HMRC actually uses, then every financial decision you make is based on incomplete information. You won't know if you're in the 60% band. You won't know if your personal allowance has been reduced, and you won't know what level of pension contribution would actually help. Adjusted net income is not your salary, it's not your gross pay, and it's often not what people assume it is. It's your total income minus pension contributions, minus gift aid, and a few other deductions. If you don't know that number, you're guessing. The fix is simple. There's a calculator on gov.uk. It takes a few minutes. Do it once, then update it whenever your situation changes. That alone will prevent most of the mistakes in this video. This is probably the most expensive mistake on the list, and also one of the easiest to fix. When you contribute to a personal pension, your provider automatically adds basic rate relief. That's the 20% most people are aware of. But if you're a higher rate taxpayer, there's another 20% available, and it doesn't get applied automatically. You have to claim it yourself, usually through a self-assessment return. A lot of people don't realize this, so the extra relief just sits there, unclaimed. If you've been contributing to a pension while paying higher rate tax and haven't claimed this, the money hasn't disappeared. It's still available. HMRC allows you to go back up to 4 years. So if you've been putting in £10,000 a year, that's £2,000 a year in extra relief you may not have claimed. Over 4 years, that's £8,000, all recoverable. It just requires taking action. This one catches a lot of people out. Things like a company car, private medical insurance, or an employer-provided loan don't feel like income, but HMRC treats them as income, and they count towards your adjusted net income. So someone with a salary of £94,000 might think they're comfortably below £100,000. But add a company car valued at £8,000 and private medical worth £2,000, and suddenly their adjusted net income is £104,000. Now they're in the 60% band. Their personal allowance is being reduced, and they may have no idea. The key thing is to check your P11D. That document lists the benefits HMRC includes in your tax calculation. The solution isn't to reject the benefits, it's simply to include them when you work out your adjusted net income and adjust your pension contributions if needed. We covered this earlier in the series, but it's worth repeating because it's so common. A lot of high earners put money into an ISA first, without fully using their pension allowance. The problem is timing. If you're paying 40 or 60% tax, putting £10,000 into an ISA costs you £10,000 of after-tax income. But putting the equivalent into a pension could cost you closer to £6,000 because of tax relief. That difference adds up quickly. The ISA itself isn't the issue. It's an excellent tool, but it works best after you've taken advantage of pension relief. Think of it as order, not choice. Pension first, ISA second. Used that way, both do their job properly. The pension annual allowance is £60,000 for the current tax year. Most people don't get anywhere near that. But what often gets missed is the ability to carry forward unused allowance from previous years. If you haven't been contributing much to your pension, you may be able to make a much larger contribution now using allowances from the past 3 years. There are a few conditions. You need to have been part of a pension scheme in those years, and your earnings in the current year need to support the contribution. But for someone who has been under-contributing and now finds themselves in a higher tax band, this can be extremely powerful, especially if part of their income is sitting in that 60% range. Used properly, it allows you to make a larger contribution and receive significant tax relief in one go. None of these mistakes are dramatic. That's the point. They're small, easy to overlook, easy to repeat year after year. And that's exactly why they're expensive. The tax system doesn't alert you when you've missed something. It doesn't tell you that you forgot to claim relief. It doesn't point out that your benefits pushed you into a higher band. It simply calculates what it's owed and moves on. The people who overpay tax aren't careless. They're busy. They're focused on their work, their careers, their families. They haven't had the time to sit down and look at this properly. I get that. I was in that position myself. What changed things wasn't anything complicated. It was just understanding how everything fits together and making a few deliberate decisions each year. If you want something practical to take away from this, keep it simple. Work out your adjusted net income. Check whether you've claimed all the pension relief you're entitled to. Look at your P11D and include those benefits in your calculations. Make sure you're using your pension before your ISA at higher tax rates. And check whether you can use any unused allowance from previous years. You could do all of that in an afternoon, and it could save you thousands. In the next video, we'll focus on one of these areas in more detail: salary sacrifice. It's more nuanced than it looks, and when used properly, it can be far more valuable than most people realize. If you recognized yourself in this video, even in just one of these mistakes, subscribe. And if you know someone who earns well but hasn't looked at this properly, send it to them. There's always someone like that. I'll see you in the next one.